We have here, and we invited him, someone who can give us a perspective of what is happening in the world. No less than the product strategist from JP Morgan, a well-recognized global investment management institution. His name is Anis Tiasiri, Executive Director. He is a Senior Client Advisor for Southeast Asia Funds, an institutional team at JP Morgan Asset Management. He is responsible for client relationships across Southeast Asia with a focus on institutional and sovereign clients based out of Singapore. Prior to this, he worked for the Tisco Financial Group in Thailand, where he was responsible for product development and management for banking, asset management, and securities businesses of the group. He began his career at HSBC, where he held roles in private wealth management and was an investment strategist responsible for investment and asset allocation strategies. So let's all welcome and hear his views, Mr. Anis Tiasiri of JP Morgan Asset Management.
Thank you very much, and appreciate you guys having me on a Friday afternoon. First of all, I want to hope that everyone is doing well, and hopefully that we are now sort of towards the tail end of this pandemic, and that we'll all be reunited together very, very soon. A very sort of belated Happy New Year to everybody, and a Happy Lunar New Year to everybody next week as well. Now, over the next 20 minutes, I wanted to take you through sort of our outlook for 2022. And primarily the way I was thinking about this outlook was really through a couple of different lenses. Now, I've titled my presentation A Partial Return to Normality, because some of the things that's going to happen this year is going to move us back to normal, but not necessarily pre-pandemic levels just yet. So what we're thinking this year is that there's obviously going to be a focus on inflation, which I'm sure you're reading throughout all the headlines. And I think this is going to be a big shift from what we were worried about before, which was primarily recessionary risks. Now, we do expect inflation to be high, but this should moderate sometime in the second half of this year. And at the same time, what this basically means is that central banks around the world are basically going to continue to move away from this emergency level of stimulus that they've had over the last couple of years and move to a bit more balanced stance. I mean, depending on what country you're looking at, some countries may tighten monetary policy a little bit more aggressive than others. But again, I think more or less we're seeing this trend shift to more balance. I'm going to touch a little bit on China as well. Obviously, it was very big in the headlines last year. I want to give everybody a bit of a health check as to where China is today. We do expect Chinese economic growth to stabilize in the first half of this year, and we do expect to see some more measures come in from the Chinese government as well. All this leads to a very sort of positive picture, I think, from a corporate earnings perspective, which I think leads us to have a much more positive view on equities versus fixed income, where bond yields rising would definitely be a challenge for a lot of our fixed income investors. All in all, 2020 should be a bit more normal, albeit not fully normal yet as compared to pre-pandemic levels. So we can go to the next page. I wanted to maybe start off and sort of address the biggest elephant in the room, which is primarily looking at COVID and what we're thinking about COVID for 2022. Now, we've all dealt with COVID around the world through a combination of hospitalizations, vaccinations, etc. But I think what's interesting now is obviously mortality rates have come down significantly, hospitalization rates have come down significantly, and even though we do have this Omicron variant that's rampaging across Asia Pacific at the moment, I think necessarily I would take a longer term view and view this a bit more as a bump in the road in the longer path to recovery. What's interesting is that obviously as we move from this, and I'm sure you're very familiar with this concept of moving from a pandemic to an endemic, I think what we're expecting is a bit more recovery in services. Now, I'm sure everyone's very familiar with issues around global supply chains last year, where you couldn't necessarily get your goods ordered in time, or certain goods were not available because certain components were missing. And I think this is going to be one of those things that's going to get resolved within 2022 towards the second half of this year, as supply chains repair themselves and as manufacturing comes back online in many parts of the world. Now, what's also interesting is obviously there is a bit of a divergence, right? US and Europe obviously have had a live with COVID mentality for much longer than we have here in Asia Pacific. And I think a lot of those countries have benefited from that primarily due to earlier vaccinations and better access to vaccinations. What's interesting now is that as Asia Pacific as a whole is reaching a vaccination rate of around close to 70%, we do expect much more flexibility in travel, in sort of mobility around the region as things go back to a little bit more normal. contrast that, unfortunately, with China, which I think at the very least should still have this zero COVID policy, at least until going into 2022 in the second half of this year. And I think from there, I think we'll need to see what policymakers think about that. But I think long story short, we are on the longer road to recovery now on a global basis rather than anything else. So moving on to the next page, what does that mean when we're looking at this from a global macroeconomic perspective, right? So if you're looking at it from a global perspective, I think it's very, very clear to see that I think looking at this chart, which I think, apologies for being a bit busy, but we're trying to showcase GDP growth across US, China, Europe, and Japan, all the way from 2019 to 2020, when we saw that large correction due to the pandemic, followed by a very, very swift recovery in the second half of 2020, and then a bit more muddled picture in 21. But the good news here is that regardless of which region you're looking at, we are more or less all growing together in 2022. Now, different quarters will have different sort of levels of growth, but I think it's very, very clear to see that whether you're talking about developed markets or emerging markets, we're all growing, albeit that the pace of growth may not necessarily be as fast as 2021. Now, this leads me to, I think, the biggest talking point or the biggest topic that a lot of investors are going to be focused on in the beginning of this year, which is inflation. You're seeing it across all the headlines right now. And if we can go to the next page, I wanted to maybe showcase to investors, what does this actually look like when you're looking at inflation? Now, I was thinking about how can I show global inflation in a way that is a bit more intuitive for a lot of investors. Rather than throw a lot of numbers onto a page, I decided to throw a lot of colors onto one page. Now, what I've done here is showcase a lot of different countries ranked by developed markets, emerging markets, and some other emerging markets for everyone to consider. And I'm showing inflation that's running below trend or above trend, right? Red being bad, green being good. Now, for the most part, I think what everyone is seeing is that post-2020, a lot of parts of the world is heating up from an inflation perspective. Now, for context, in developed markets, I think a lot of central banks are targeting a 2% level of inflation. Whereas right now, if you're looking at Europe, you're looking at the UK, you're looking at US, a lot of these places are reaching double, even triple of their targets. So I think this is obviously a cause for worry, because once inflation gets out of control, that leads to rate hikes, which basically makes cost of funding, cost of borrowing much more expensive, which then the trickle down effect of that is that companies may not finance their debt, they have to close down, people can't service their borrowing to the bank, so they have to default on their loans. So I think that's a longer term concern and implication that everyone's worried about. So what do we think about inflation for this year? So let's take the US as a prime example, right? So inflation in the US right now is hovering at around 6 to 7%, which is very, very, very high, right? So we actually expect inflation right now in the US to moderate in the second half of this year to close to around that 3% mark. So more or less than half of what it is now. So there are a couple of things we're thinking about in the US. And again, you can see the chart on the left here, you're looking at that big spike in inflation. That's what's causing a lot of people to be concerned about. There are two parts to the inflation story. One which we think is short-term, one which we think is a little bit more challenged, and which is the reason why inflation won't go all the way back down to below 2% like it was before. Now, one of the big drivers of inflation this year, and sort of coming into from last year, is really higher oil prices, higher energy prices, right? Now, one of the things to bear in mind is, from our perspective, we don't expect oil to go up to $150 a barrel like it did several years back, primarily because there is a bit of a hard stop. Once oil reaches a certain price, then US shale gas becomes really profitable, and the cost of shale production has actually been coming down over the last couple of years. So eventually, we do see that the US could automatically just switch on shale production, increase the supply, and overall energy costs will come down. So that for us is one of those factors that drives inflation that we're not necessarily too concerned about. But where we are a little bit concerned are two particular areas right now. One is if you're looking at US housing. Housing costs has actually risen significantly in the US over the last couple of months, whether that be sort of housing prices or rental prices. And this is an area that's typically stickier because obviously rent doesn't necessarily move month by month, it moves year on year. So this is an area where we need to be a little bit mindful of because it won't go away that time soon. The other one, which I think leads quite nicely into what a lot of people are talking about, which is really wage inflation, right? Which we're talking about salaries. Now, a lot of people are a little bit concerned around this, primarily because right now, wages in the US obviously have been steadily climbing, but at the same time, there's a reason to this, right? Because if you think about sort of like the sort of what a lot of people have sort of lived with in the US, whether it is through sort of all the stimulus packages, whether it is through all the sort of like increased savings, not having to sort of spend or cannot travel. A lot of people have actually not really returned into the workforce in the US right now. So if you look at unemployment rates in the US, which you can see on this particular page, it's actually come down to sort of below 4.2% in the US, which is relatively low, right? And this was at its peak back in 2020 at about 14%. So that's a 10% drop in unemployment. Now, there is still a very, very strong demand for workers at the moment, primarily because businesses are opening up. People have lived with COVID for a while and they're continuing to live with COVID. So there is demand for people to go out, to go shop, to go travel. So there's a big demand for workers in America at the moment. But this is key. Participation in the workforce has actually come down. Now, what do I mean by this? What I basically mean is the number of people willing to work in America has actually dropped. How much, you ask? So if you look, I'm looking at the data right now. The current participation rate for sort of US unemployment at 2019, so pre-pandemic, was about 63%, which basically meant 63% of people in America were willing to work, were part of the workforce. Today, that number is below 62, about 61.8%, which basically, if you translate that into an actual number of people, that's close to about 2.6 million people who've just basically left the workforce, right? So one of the things to bear in mind, it's probably one of the reasons why the Federal Reserve in the US is not necessarily being as aggressive as they have been in the past, is primarily just basically to look at whether or not this participation rate would come back. But this is one of the main drivers that we need to really focus on, because that's basically pushing wages higher, because you can't find people, you got to pay them more, and you got to pay them more to stay and not actually leave the workforce. So going into sort of the next page, what this basically means is that inflation is going to kind of be here with us for quite some time, right? Now, why is this a challenge? It's a challenge because what does inflation lead to? It leads to higher interest rates. Now, the graph on the left just shows you interest rates across US, UK, Europe, and Japan. And obviously, this goes back until the year 2000. And you can obviously see how low interest rates have become over the last couple of decades. Now, our expectation now going forward is that basically because inflation is so high, the Fed kind of needs to play catch up at the moment, right? So what is going on right now is that we actually expect the Fed to start hiking as early as March this year, at about 4 times this year, about 0.25% every single quarter. So we are expecting about 1% increase in interest rates this year. Now, is that a lot? In reality, not so much, because if you think about it, the Fed could actually increase at much higher magnitudes or even higher frequencies to combat inflation. But again, like I mentioned, they want to be a little bit a bit careful about hiking rates too fast. Otherwise, they're basically going to choke up the economy by making borrowing costs way too expensive. So again, this is one of those things that we need to be mindful of. But a lot of this is already priced into the market, which is kind of why you're seeing so much volatility in US equities at the beginning of this year. Now, moving across the pond on the next page, looking at China, I can spend a couple of hours talking about the Chinese outlook, but the quick version of this is China was first in, first out in a lot of different ways. So China caught COVID before everybody else. They recovered from COVID before everybody else, as early as the third quarter of 2020, in fact. They had their economic activity peak in 2021, and ever since then they've actually been sort of winding down, and a lot of this is sort of led by a lot of the regulatory reset that the Chinese government did last year as well. So while the rest of the world is still on recovery phase, us in Asia, for most part of Asia, unfortunately, we're still at the beginning stages of recovery. US and Europe are kind of at the middle stages where the economy is peaking, whereas China, they're actually already at the late stage of an economic recovery where the economic activity has already peaked. And now, right now, what we're seeing is that the Chinese government is actually introducing new stimulus measures to engineer kind of a soft landing. Now, the way we're looking at China is obviously we can go into the whole idea around common prosperity and things like that down the line in the Q&A session. But what we're seeing right now is there are still ways of investing in China, even though there is not as positive of a macro backdrop. Obviously, we know that China is laser focused on decarbonization and ensuring carbon neutrality. So this is an area where we're really interested in right now, because China basically controls 80% of the solar market around the world. So there are opportunities still in China. There's the technology import substitution theme, where China is actually manufacturing more in the hardware space. And there's obviously areas around sort of the consumer goods and premiumization and the rise of the middle class in China. So even though China right now is at a much more advanced and later stage of the economic cycle compared to other parts of the world, that doesn't mean it's not investable. So I think all in all, we're actually still pretty positive on the picture. Now, that's my sort of first bit on the macro side. And maybe just take a step back and think a little bit about what does that mean for us as investors today, right? We are in an environment now where obviously some parts of the world have recovered, some parts of the world are still recovering, some parts of the world have already passed that point, right? We are at a stage of the world now where inflation risks have outweighed recession risks. We're at a part of the world now where we're actually thinking interest rates are going to rise in a meaningful way in different parts of the world going into 2022. So what does that mean for us as investors? At the end of the day, for us right now, we still see broadly, as you saw in the sort of the first couple of slides, broad economic growth across many markets around the world, right? For us, this translates quite nicely into sort of corporate earnings, which does lead us to believe that it is going to be a better year for equities than it is going to be for fixed income this year, especially on the back of rising rates, which obviously it would impact negatively to bond prices. Now, at the same time, nothing's necessarily cheap at the moment. You look at valuations for the US, valuations for Europe. The argument cannot really be made that these are sort of attractively valued markets at the moment. However, there are still pockets of value in the sort of Asia and China, for example, where we have actually seen, obviously following the derating that happened last year, some parts of the market are still actually being quite attractively trading at today's levels. Now, at the same time, if you are a fixed income investor, this is, I think, a year where it's going to be particularly challenging, obviously, because rates are rising. We are going to see a bit of a sort of risk for a lot of bond investors, especially sort of government bond investors in 2022. There are parts of value still. Chinese fixed income is a really interesting area at the moment if you can stomach the volatility. There are certain parts of emerging market fixed income, which is quite attractive. But for us right now, we still think there's some potential downside there. And we are waiting on the sidelines, actually waiting to jump back in on this place. So I think more or less, this is what we're thinking, broadly speaking, from an asset allocation perspective. Now, if we zoom in on equities, right, I think this page summarizes it quite nicely, which is if you're looking at corporate earnings, if we can go back to page 9, please. So when you're looking at equities, one of the things I obviously will always look at is if you want to focus on corporate earnings, because ultimately that's the longer term driver for equities. Sorry, if we can go back one page, please. Now, 2021, I think, would definitely mark the peak of corporate earnings growth around the world, right? So you can see that very clearly on the left-hand side chart there. Oh, sorry, page 9, please. If you look at corporate earnings across US, across emerging markets, across Asia Pacific, you'll see basically that sort of corporate earnings has actually peaked quite substantially. And there is a reason for this. Obviously, there was no earnings in 2022 during the pandemic. So any improvement on a percentage basis would look significant, right? But that being said, we still expect positive earnings growth across the world in 2022. And while it may not be as high of a magnitude as it was in 2021, in many parts of the world, it's still at higher than longer term trend growth for corporate earnings. So this is going to be a key picture. So expect positive returns from equities this year, albeit at a much more modest level than what you could get in 2021, right? But again, if you notice on this page, there is significant variation across different parts of the world, and valuations at different parts of the world are also very, very different. So I think one of the things to bear in mind is you have to be a little bit more selective in 2022 than you had been in 2021. Now, shifting gears on the next page and looking at fixed income, and I think this is an area where a lot of investors are going to find a little bit more challenge in 2022, primarily because obviously interest rates are moving up, bond prices will come down. So for a lot of investors right now, having flexibility within fixed income is key. Having the ability to hedge duration out of your portfolio is key. But that doesn't mean there aren't opportunities within fixed income. You just have to know where to look, right? Suffice to say, developed market government bonds are really not going to give you anything, and they haven't for many, many years. Investment grade government bonds, investment grade corporate bonds have actually been moving down for several years as well in terms of yield, because this is kind of the next most safe asset class. So a lot of institutional investors, pension funds, insurance companies, central banks have been moving into this space, and just the sheer volume of their money has basically pushed yields down to the levels that you're seeing today. Where we see some opportunities is in sort of the high yield bond market, because a lot of this is supported by the strong earnings growth that we see this year. And we're also seeing opportunities in some emerging market debt as well. So there are pockets to look at, but you have to be very, very specific. Now, moving on to the next slide, I think one of the things I wanted to sort of talk to you especially, and this resonates with a lot of investors within Asia Pacific, is this sort of persistent need for income. All right. You saw on the page before that obviously buying government bonds is really not going to do anything for you, especially in an environment where inflation is so high that you basically need to find more income to offset that. Otherwise, you lose out to inflation, which is the biggest killer of them all. So I wanted to basically show everybody on this call right now where you can find income in 2022. Right. One thing kind of stands out apart from most is obviously the yield numbers are not high. And I think this is consistent whether you're looking domestically, internationally, or regionally. But that being said, there are still pockets of income that you can achieve. Some parts that we find really, really interesting. For example, if you look at sort of the third or fourth column from the left, that's sort of the orange bars there, looking at denoting equity. Within Asia Pacific and emerging markets, it's actually a very fertile hunting ground for high dividend equities at the moment. And what's really interesting is a lot of times these companies tend to pay out higher dividends when corporate earnings are on the mend, when they're recovering as well. So right now you're getting around 5% yields. We actually think there could be room for increases in dividends within Asia Pacific. So that for us is a really interesting area where we're exploring with a lot of our clients at the moment. Another is for clients who do have that higher risk tolerance. Obviously, the high yield bonds within Asia Pacific, specifically in China, offer quite a lot of value right now, primarily on the back of the massive derating we saw within Chinese property fixed income last year with the whole Evergrande crisis. If you X away all those troubled names, whatever's left, fundamentally driven, offer really good attractive value at the moment, right? I'm primarily not really going to touch so much on the blue, given that obviously these are sort of like more institutional grade private market asset classes where you're effectively investing in airplanes, ports, ships, railways, and roads, right? So these are where you can actually get more yields with less correlation to markets, albeit there is basically no liquidity in these asset classes. And I think for a lot of people on this call, for this year going forward, I think liquidity is going to be a really important consideration. So maybe just to wrap up on this presentation, and I can hand it over to the next speaker. I think right now what we're seeing from an investment implication perspective is that I think as we are in this economic recovery, sorry, if we can go to the next page, please. We have elevated inflation, we have sort of monetary policy normalization in the form of central banks tightening rates. At the end of the day, we still think it is a more favorable environment for equities than it is for fixed income. As long as corporate earnings can continue to expand, as long as sort of margins can get repaired, as long as sort of supply side constraints continue to repair themselves, we're generally still quite constructive, right? The magnitude of the returns this year are going to be more modest than they were last year. But that being said, it doesn't mean that investors cannot generate returns in 2022. The key is to understand where you fall on this particular spectrum right here, right? Because I think volatility is going to be quite elevated, as we've seen already this month across many markets. If you look at the political calendar for the US and China and different parts of the world, it is a fully stacked political calendar in the first half of this year. So that's obviously going to add a lot of noise for a lot of investors at the moment. For fixed income investors, the key at the moment is to be really short on your duration and your fixed income exposure to manage that risk against rising rates, have that flexibility in. If not, then I think maybe explore some other ways to do that. And an interesting way of doing it is actually to have a bit more of a multi-asset, a bit more balanced approach where you can kind of have the best of both worlds, having the ability to move tactically in between all these asset classes, while at the same time having that derivatives element to overlay and basically manage your duration in the overall portfolio. So again, it's key to understand where you fall on this page and you can make your decisions accordingly.
Thank you very much, Anis, for that. Yes, thank you very much. It looks like things are moving to normalcy. Growth will remain now over the long term. It's still going to be there, but we are facing risks, higher inflation, high interest rates. So difficult to earn bonds, but equities are preferred investments. Right. Thanks, Anis.